Hello everyone. This week in US markets is truly a super financial week. The ghost the Fed fears the most, the CPI inflation data, is hitting the markets this Wednesday. It will directly determine if the Fed will completely abandon its hope for a rate cut. To make things worse, the US political scene is sounding the alarm again. The government shutdown crisis is still unresolved. How big will the impact of this deadlock be on market sentiment? From CPI data to political deadlock and the crazy rally of tech giant Apple, this week's market is full of opportunities and traps. In the next few minutes, I will provide an in-depth analysis of how investors should respond. First, let's look at the most crucial event this week, the Consumer Price Index. The market expects the year-over-year rate to be around 3.1%, slightly higher than last month's 2.92%. Why is this data so critical? Because it directly relates to the Fed's future monetary policy path, especially the highly anticipated timetable for rate cuts. Scenario 1. CPI unexpectedly cools if the data is lower than expected, showing continuous easing of inflation pressure. The market will celebrate. This will solidify traders' belief that the Fed will start cutting rates before the middle of next year, and the stock market will see a strong rally. Scenario 2. CPI unexpectedly rebounds, but if the data exceeds expectations, reaching 3.3% or higher, it will be a disaster for the market. The stickiness of inflation will force Fed officials to adopt a stronger hawkish stance. Market optimism for rate cuts will be completely shattered, and long-term US bond yields could spike again. Therefore, investors, please pay close attention to the data released this Wednesday. This will be the key moment to determine your asset allocation. A single number change could decide whether you should be greedy or fearful. Next, we cannot ignore the dark cloud hanging over Washington, the US government budget deadlock. Although there are reports that talks between the White House and Congress may make progress this week, potentially avoiding or quickly ending a shutdown. But we must understand that the deadlock itself is uncertainty. Historical experience tells us that while short-term shutdowns usually have limited impact on the stock market, in the current high-interest rate environment, this political risk can easily be amplified. What is the real impact of a shutdown on the market? Firstly, the release of economic data may be delayed, depriving investors of crucial information. Secondly, if the deadlock persists, defense industries and companies with federal contracts will be affected, and the temporary furlough of civil servants will impact US consumer spending. The conclusion is, while we expect the deadlock to be resolved this week, investors still need to be vigilant against any sudden bad news and incorporate political risk into their investment considerations. Let's turn our attention to the crowd favorite, Apple. On the day the Dow Jones Industrial Average soared over 500 points, Apple was the undisputed leader. The market's optimism towards Apple is primarily supported by two factors. First, strong sales of the iPhone 17 series are expected to drive a wave of device upgrades. Second, strong expectations for the upcoming earnings report, especially the continued robust growth of service revenue. But here's the question, is it still worth chasing the high? We must remain rational. Apple's current stock price has already priced in most of the good news, and its valuation is at historical highs. Investment opportunities might lie in the supply chain. If you miss this rally in Apple stock, you might consider those supply chain partners who directly benefit from the strong iPhone 17 sales. Their gains might be more explosive. However, if the earnings report falls short of expectations, the correction pressure on Apple's stock will also be greater. Closely monitor the latest news from Apple to decide whether you want to lock in profits or continue to hold this tech giant. Next, we must sound the alarm: regional banks and credit risk. While the bank earnings reports released last week, such as those from Truist and Fifth Third Bancorp, generally showed positive signals with credit quality seemingly under control. However, this does not mean the crisis is over. In a high-interest rate environment, the repayment pressure on businesses and individuals continues to increase. The slight rise in banks, non-performing loan ratios, and delinquency rates must be seen as a warning sign. Analysts are generally concerned that while the big banks are safe, some smaller regional banks may still face pressure from deteriorating asset quality. The market could overreact to any news of fraud cases or increases in bad debt. Therefore, when allocating capital to the financial sector, be sure to avoid regional banks with more fragile balance sheets. Prudence remains the #1 rule for investing in bank stocks right now. In summary for this week, the direction of the US stock market will be entirely dominated by data and politics. My overall investment advice is, before the CPI data is released, it is advisable to maintain a moderate cash position to avoid betting heavily on one direction. Once the data is finalized, whether it leads to a rally or a correction, adjust your strategy based on the trend. If this video has been helpful to your investment decisions, please don't forget to subscribe to our channel, like, and share it with your friends. We will continue to track the latest market developments next week. See you next time.